Well, good morning slash afternoon, depending on where you are coming to us from. How's everybody doing? You are here with Mike Shorr. I am filling in for my good friend and our CEO, Scott Bauer. How's everybody doing? Let's just see. There we are. All right, all right, all right. So I want to I want to thank you and appreciate you for coming in today. If you like what we're doing here, hit that subscribe button and smash that like button. That will really, really help. Okay, so today, where are we? There we go. There we go. So, my thoughts are that we were going to talk about statistical skew, time frames, and then we can go over any questions that you have regarding options or the outside markets or the markets in general, or what my feelings are, or anything to do with any specific stocks that you're looking at. Thank you everybody for hitting that smash button. Okay, so what is statistical skew? All right, so skew means that things are not in balance, right? It's balanced from one way or another. But do they apply to options? 100%. Yes, it does. Okay, so volatility skew, normal or no skew would look just like a bell curve, that we have no idea what's going on in the market. And so we're just going to treat this as a normal slash Gaussian distribution. We know that's not the case, though. And you know what? I am going to pull this off, and I am going to just bring up. Okay, so volatility skew. If I can type, volatility skew. We know that all strikes are not created equal. I guess if I want to be a math or an English major, are not created equally, right? So within an underlying, the IVs of the different of the strikes will be different. Yes? So a typical I'll just say equity skew. Looks like this. All right, I'm going to have to bring up my drawing tool here. Typical. It's going to look something like this. With your at the money volatilities. Okay. Why would that be? So wait, I guess I should ask, does everybody understand that different strikes have different implied volatilities? Let's just pick up something that we all know. Let's go Microsoft. So, and let's go out to something a little bit more normalized, like here. So we can see my drawing tool up here, that the calls have an implied volatility essentially the same. It's not intrinsic value, Kevin. It's not an intrinsic, it's extrinsic. And then if we look at the implied volatilities on the downside, we're looking at a picture like this, much like what I have here. So if I get my drawing tool back up, all right, so this will be implied volatility here. And then this will be your strike. A million apologies for me being able to draw with my mouse. So we see that implied volatilities of things that are below the money or puts are higher than at the money volatilities and the calls shortly thereafter. Why is that? I'm going to get rid of this just so I can continue to type. IV. I'm just going to put this out there once. Why would that be? Vol crush? Well, if vol gets crushed, everything gets crushed, Al. Why would that be? Here are two main reasons. Number one, what's a natural position? What's the natural position of somebody holding a stock? Long or short? I'll give you a true or false answer. Or an A versus B. Exactly. So, given that, I'll just say they have a number of choices. But one would be to sell calls against their long position, right? We do that investment wise. We talk about it all the time. We don't trade these things. But one would be to sell calls against their long position. Either their call gets called away and then they have to deliver, their stock gets called away because it got to a point where they sold some calls. So you can sell calls against your long position. That's called a covered call. I am a great typer. And then number two, if they want protection against that long position, haven't been able to spell that. You're right. It's today. They want protection against that long position. They buy puts. They buy insurance against their long stock. So The simple explanation is that there is a supply demand issue here, right? Either from if I'm a long stock holder, either I can hold the stock and do nothing. If I want to try and get some yield enhancement by selling an upside call against it, or if I want to buy protection, I am going to do that by either buying puts or selling calls. And thus the laws of supply and demand say, well, if you're buying puts and selling calls, we are going to have a curve that looks like that. Let's look at something. Let's look at, I don't know if NVIDIA is going to be a great example, but we do see, actually, NVIDIA is probably not a great example of that. Let's look at something like IBM. Let's look out to regular AUK. And we see that basically up until, and IBM is trading 280, we see a very flat vol curve. Very flat. And then when it gets down, when it gets down to kind of smaller options, then you see a little bit of call skew here. That's what I was trying to point out here by what it looks like is more like this, bottom out, maybe even a little, and then the tails are always going to be tails. Tail risk is always something that you want to make them pay for. And this being, right here at the money. Sorry if I'm just drawing over my own text here. But the natural thing to do is sell calls and buy puts. And so the supply demand curve looks like that. Now, sometimes, let's look at something that's kind of going here, like NVIDIA. NVIDIA flattened. Actually, NVIDIA is not all that different. I'm trying to think of something that possibly can take off here. Reddit, maybe? Okay, so something like Reddit, which has been a high flying stock this year, right? Let me get rid of these things so it doesn't confuse you. And let me get ourselves a little bit. So now, NVIDIA does look like this. Let me get my drawing tool here. It looks pretty similar. Why can't I draw? There we go. NVIDIA looks something like this. We get a big move up in NVIDIA. There's still some, if this is at the money, that's what it looks like. Now, let's get rid of this. Reddit, I guess I have to put it in. If we look at something like Reddit here, look what the implied volatility does there. There's also some put skew. What this tells me, this is a volatile stock. So Reddit looks more like this, more like a smile. Again, excuse my drawing with the mouse. There's call skew and put skew. Because we've seen Reddit take binary moves up and we've also seen pulls back. That makes sense because of this. Ross, yes, you have to do a covered call. You have to own the shares. What if you want to make profit for your shares without losing it? Um, Sell an out of the money call that you don't really care if you get pulled away from. So, like I said, a typical equity curve looks something like that. I'm not going to quibble with little stuff, but there are stocks. I'll just say this is typical. Very hard to draw with a mouse, isn't it? All right, so that's typical. Now, what type of stock might not have that type of landscape to it? We've also seen something, I mean, I showed you, and this is not very pronounced call skew in Reddit. It's a little bit. It's more like kind of like, and then like that, with that being at the money. It's not crazy. But what types of stocks could have something that looks like maybe even this, or maybe even this? What type of stocks could do that? Remember, where's the shock? Where's the pain coming from? Dorothy makes a good example. Bitcoin. Bitcoin could go down 10%. It could go up 30%. Let me get rid of these so it's not so confusing. Sorry about that. Go. Meme stocks, exactly. Something like back in the day, like AMC or GME. Or what about something like a pharmaceutical stock that has maybe 3 drugs that they're developing? And if one of them works and people benefit from it, you have a $5 stock that goes to a $100 stock. Or something like corn or soybeans or wheat. Where's the shock to the market coming from? The shock to the market in the corn markets, and I'll just say corn in general, things like drought, floods, embargoes. Suddenly, a corn skew will look like that. Because when things get crazy, or something like beef, anything like that, where supply is way more in demand than, I'm sorry, that demand is way more because, I mean, think about it. If you are a meat producer, an end producer of any sort of grains or anything like that, the cornfields getting flooded out, you're going to have a tough time making cornflakes. So you'll see those in there. Pharmaceuticals, we talked about that. Where you have a stock that has a couple, I mean, it's really not going to do much to something like Pfizer because they have hundreds of drugs in their portfolio. But a startup that, let's just say, cures all cancer, God willing, suddenly that's a $5 stock that goes to $500. So you're going to see that call skew up there. So it's supply and demand. It's also how the market tends to react. So if we were looking at a Q, you would think that you would have something kind of like that in Qs. Why? Because the market acts much more violently to the downside than it does to the upside. As we're going up here, we continue to rally. There's not a lot of fear. There's no reason. There is no reason to get all freaked out about this. Sorry, trying to get. All right, I do want to get the word of the day out there. We will continue our. Get rid of these here. I want to get into this. All right, first thing before we get to the name of the day, you guys, ladies and gentlemen, you get the Ultimate Trader's Experience, and we are excited about this as much as you are. We're all going to be there. We're going to hang out. We're going to learn a lot about trading and options trading and every other sort of trading, and we get to hang out with each other. Do we have a link? Do we have a link for this? I do have a link, but if we can put that in there. Spaces are limited, and we are pushing those spaces, but I would really, really love for everybody, if you can, come and hang out with us. It would be great. Who's going? I'm going. Dorothy, I hear you're going. Thank you, Mike. Mike just pop that in there. Copy that. This is going to be really, really, really fun. And we're going to learn a lot about each other. We're going to learn about trading. Okay. Let me get the okay. Who knows who this is? I'm going to wait because it's worth it. I know it's Fly the W. I didn't ask what it said. Who is that? It's Lou. It's Louie. This is Scott Bauer's first grandchild. And we are more than blessed and more than happy. And so we're going to fly the W for her for sure. So this is Scott's oldest son. His daughter born this past weekend on the 15th or 16th. Trying to remember. But anyhow, fly the W. One for the Cubs last night. We're going to hope for another one today. And more importantly, we have a new Bauer in the family. So throw your names in there. Let Mike get caught up with this. But she is just absolutely adorable. All right. So now the other part that I want to talk about, we talked about Skew, okay? I also want to talk about the time structure of options. So it's not a huge It's not a huge difference from what we were talking about before. But time structure, well, that clearly involves time. And it refers to the difference in IV between expirations. Okay, so we have two conditions. Well, I guess three. All right, flat. So does everybody understand that not only do we have difference in implied volatility over strikes, but we have implied volatility difference between the different expirations. Now, something like we're just gonna because Reddit's down 9%. Let's get something a little bit more tame here for our example. Okay, so for in general, and we do, and I'm gonna kick out these October 3rds because we don't know if we're gonna get non-farm payrolls on Friday. Right? The government shut down. That means that government agencies are shut down. Typically, we would expect something a little bit different than this. But if you look that over the past or over the next few weeks, implied volatility is basically the same. So we have three formations of IV over time. Flat, contango, backwardation. Okay, flat. This means that the IVs of expirations are essentially the same. Straight horizontal line. Contango, this means, I'll just say, this is a normal condition. Short-term IV, I'll just say kind of equal. With longer term IV a bit higher. All right, so hang on, let me grab my drawing tool here. That's flat. Again, sorry about these. Contango. Man, that is really bad. Contango. Meaning that the near term landscape that we see is pretty solidly put into what we think is going to happen. But we do entertain the fact that going out 3 weeks, 5 weeks, 6 months, whatever it is, implied volatility will probably be higher. And then we have what's called backwardation. I'm just going to put back here because I don't want to embarrass myself anymore. So, backwardation, when short term is higher than long term. When would that happen? That happens when the world doesn't know what the heck's going to happen very, very soon. But over time, we're just going to continue to mean revert. So this would be a situation where backwardation might come into play. Now, with us rallying from being down about 0.5% this morning to being up 1/3% this morning, somewhere between 25 bips and 30 bips, depending on what you're looking at, things seem to be okay. Oddly enough, the government shuts down. That should be like everybody's hands off. What the heck is going on? Sell my stocks, buy everything else, buy all my defensive things. We're not really seeing that so far. But when things get into a backwardation type of situation, usually that can't hold for very long. You just have to be able to weather the storm, so to speak. So flat and contango, I kind of throw into the same. When things get into backwardation, take a look at VIX. I haven't really looked at VIX yet today. Come on. Okay, so what we see here, let me clear this out here. VIX options for today, since they are expiring, have an implied volatility of 156. Why? Well, because the government shut down. And then you see that we get more into, I don't know why we have this little dip in here, but you can see how if we kind of draw a least squared method or a linear regression between the two, we see short-term implied volatility higher than long-term. Why? Because there is no certainty what's going to happen in the next few days with this government shutdown. You want to be short VIX here? I don't. All right, wheel time. Let me grab this. Um, we're going to do the wheel here. All right, we're going to do the wheel of names here. There's going to be a lot of them, which I appreciate more than anything. All right, wow. All right, yeah. Let's get rid of my scratch here. We do got a full wheel, and I appreciate it. All right, let's see what we got. Oh, Teddy or Todd? Todd. Teddy, you were holding on by a thread. All right, so Todd, Mike will post that. Not me, Mike. Mike will post. I believe it's what's the link here? The prosperous student. Oh, I'm sorry. I have not been keeping up with this. This gets you into the raffle for a free trip to Vegas to meet with us. I don't know how many people are going to be in there. That's okay. But at least you got a shot. Todd, I hope you're able to get there. And everybody else that's won, I hope you're able to get in there too. And there will be an exciting spin of the wheel. Who gets to go to Las Vegas for free? I'm rooting for you. I'm rooting for everybody that's been on the wheel. All right, everybody. I want to say how much I appreciate you guys showing up today, and hopefully we learned a little bit today. If you have any questions, let me just throw out my email address here. Any follow-up questions? Please email me. Spur Trading. You can email me anything, topics that you'd like for us to talk about. Scott, Charlie, me, Dan, we're always looking for what you want to talk about. So please don't be shy. I really, really appreciate you guys showing up today and spending a little time with me. Everybody be self, be happy, be kind to each other, to have some fun, and hopefully we get a little bit more out of this market than this just kind of painful grind. All right, thank you for showing up, everybody. I look forward to my next time that I get to visit with you. Everybody have a great day, and I will talk to you shortly.